First Deputy Governor, Second Deputy Governor, Chairman of OMFIF, members of the Bank's Advisory Committee, Chairperson and CEO of the Mauritius Bankers Association, CEOs of banks, dear colleagues, ladies and gentlemen, a very good morning and a very good afternoon, depending on from where you're joining us today. It is my pleasure to welcome you all to this maiden edition of the Bank of Mauritius Thought Leadership Series, an initiative that the bank is bringing to the banking community and other stakeholders in general on topical matters in this fast-changing world in which we are living today. I wish to thank the OMFIF for partnering with the Bank of Mauritius for this inaugural edition also. The bank's Thought Leadership Series will allow us to gain from the precious insights of world-acclaimed experts and personalities on key topics impacting directly or indirectly the banking and financial world. It will serve as an ongoing platform to generate ideas on how we need to adapt or readapt ourselves and our value propositions. This becomes even more important for highly open small island economies like Mauritius, dependent heavily on tourism and financial services. The Bank of Mauritius will make its Thought Leadership Series a regular feature going forward on topical matters. Our choice of the theme for today, for this debut of the Thought Leadership Series, Banking Sector Resilience, Global and Domestic Perspectives, is explained by the importance of preserving stability and resilience of the banking and financial system amidst the global COVID-19 pandemic that has struck us since March last year. As a matter of coincidence, I started my governorship at the Bank of Mauritius with the outbreak of the pandemic. This theme is attracting significant attention globally. The BIS, the IMF, the OMFIF, the OECD, and many central bankers are relentlessly reflecting on how best to maintain stability and resilience of the banking sector. I am more than determined to continuously engage with our international partners as well as our local stakeholders in this ongoing reflection exercise. My objective has been to ensure that our banking sector and financial system stands the test of this unprecedented crisis that Mauritius is facing. Maintaining trust and confidence in the banking sector is a very high priority on my agenda. The more so that sound banks mean that individuals, households, and businesses can be supported in both good and bad times. The escalation of the pandemic led to the closure of borders and the imposition of confinement measures, which significantly disrupted activities in our key sectors. As a result, in the year 2020, the economy witnessed its worst contraction ever. The economic impact could have been much more damaging without the support of the central bank. In delivering on its objective, the Bank of Mauritius has, since March last year, introduced its COVID-19 support program. Faced with this unparalleled situation, the bank has been very proactive and effective in rolling out a mix of both conventional as well as unconventional measures to deliver on its core mandate, which includes maintaining price stability and promoting the orderly and balanced economic development of Mauritius, as well as preserving financial stability. Some of the key measures that we rolled out are the lowering of the policy rate and the cash reserve ratio in line with the accommodative monetary policy stance, the introduction of a special relief amount through banks to allow businesses, including SMEs, to meet cash flow and working capital requirements, a one-off exceptional contribution to government for economic stabilization purpose, the introduction of moratoriums to alleviate financial strains on individuals, households, and businesses, and a panoply of other regulatory forbearance measures. In addition, The Mauritius Investment Corporation, which the bank set up in May last year, has been instrumental in preserving resilience in the banking sector. The MIC has successfully prevented potential failures of systemically important domestic companies. This has mitigated contagion risk from the real sector to the banking sector. The MIC continues to play a critical role in reshaping the economic landscape of our country. Furthermore, in delivering on its mandate, the Bank of Mauritius has bridged the significant shortfall of foreign exchange inflows by regularly supplying foreign exchange to the market. By so doing, the bank has been able to avoid heightened economic and financial vulnerabilities that would have posed a major risk to price stability in the country. The pertinence of our strategy to preserve banking sector resilience is evidenced by the stability that we continue to experience on the front. Indicators are self-explanatory. Banks remain well capitalized with a capital adequacy ratio of 18.7%, which is well above the minimum regulatory requirement. The asset quality has also remained strong, with overall non-performing loans ratio improving to 5% as at the end of March this year, from 5.4% as at the end of September last year. The liquidity coverage ratio stands at 250.6% as at the end of March 2021, well above the required level of 100%. Ladies and gentlemen, what matters most and what matters even most for our CEOs with us here in this room today is the fact that the banking sector continues to be profitable. Profitability enables banks to continue building buffers. Stress tests conducted by the Bank of Mauritius confirm that banks remain resilient. However, the reality is that we cannot sleep on our laurels. This is the time for us to gear up for the challenges ahead. We are well aware sooner or later the support measures would need to be unwound in a phased manner. The critical point here is to ascertain that any unwinding of any support measure does not lead to financial stability risk. The phasing out of any measure must be done very cautiously. This is the reason why it continues to retain the attention of central bankers around the world. To this end, the ongoing collaboration of the Bank of Mauritius with international organizations and counterparts remain very critical. The banking sector has played and continues to play a key role in the application and success of the above support measures. I have to place on record the ongoing support from all banks, all CEOs, and all stakeholders in navigating the banking sector through the pandemic. The two task forces that I set up in March last year, notably the task force on COVID-19 support measures and the task force on banking sector resilience, chaired by the first Deputy Governor and the second Deputy Governor, respectively, continue to work in very close collaboration with the banking industry with the aim to maintain soundness of banks. In conclusion, it is important to note that the banking industry is being looked upon globally as a catalyst for economic recovery. Same is the case here in Mauritius. I look forward to the banking industry playing its role in the domestic economic recovery and boosting the country's resilience overall. The choice of banking resilience as the main theme of today's Thought Leadership series translate my commitment for the Bank of Mauritius to leave no stone unturned in accompanying the banking industry in this very important task. To this end, the Bank of Mauritius will continue to do whatever it takes to accompany the banking industry. Ladies and gentlemen, although we cannot have all of you physically present here with us today due to the prevailing sanitary conditions, I look forward to interactive discussions from CEOs of all banks present in this room with our eminent panelists. I have also taken note with satisfaction that the entire banking industry is following us in this discussion through various virtual means. For our first edition of the Bank of Mauritius Thought Leadership Series, I would like to thank our panelists also. They have taken time out of their very busy schedules to be with us here today. We are privileged to have with us Professor the Lord Mervyn King, Dr. Vera Songwe, Dr. Natasha Vala, Dr. Robert Wardrop, and Mr. Daniel Esu. I also would like to thank Mr. David Marsh, Chairman of the UNFIF, who has kindly accepted to moderate today's panel discussion. On this note, ladies and gentlemen, I wish you all successful deliberation, and I thank you for your attention.
Yes, thank you, Governor, and I hope everybody can hear me. My name is David
Thank
Marsh.
you so much, Governor. I think the message is loud and clear, and I think the presence of the CEOs in this room shows the commitment that the banking industry has to accompany the bank in its efforts to make things better for the country. By way of introduction, I understand that most of our panelists have already joined us online. So I will just give you a brief overview of their impressive track record. And forgive me, and I'd ask the panelists to forgive me for shortening such track records. So we have as moderator Mr. David Marsh, who is the chairman of the UNFIF. We also have Professor the Lord Mervyn King, former governor of the Bank of England, Professor of Economics and Law at the New York University, and former Professor of Economics at the London School of Economics and Political Science. Welcome, Professor the Lord. We will also have Dr. Vera Songwe. Unfortunately, she will be joining us a bit later. She's the Executive Secretary of the United Nations Economic Commission for Africa and former country director for Senegal, Cape Verde, Gambia, Guinea-Bissau, and Mauritania at the World Bank. We will also have Dr. Natasha Vala, Dean of the School of Management and Innovation at Sciences Po Paris. She was also the former Deputy Director General of Monetary Policy at the European Central Bank. We also have Dr. Robert Wardrop, Director and co-founder of the Cambridge Centre for Alternative Finance at the University of Cambridge. And he's the Professor of Management Practice at the University of Cambridge Judge Business School. And last but not least, we will also have with us Mr. Daniel Esu, Chief Executive Officer of the Mauritius Bankers Association. So the scene is set, and we now leave the discussions to Mr. David Marsh and his panelists. Thank you.
Thank you very much, Mr. Faisal, and I'm very pleased to be here and to have such a distinguished set of discussants. We seem to be a bit gender unbalanced at the moment, because I believe both Vera and Natasha will be joining us a little bit later on. So I'm looking forward to the discussion about the present upheaval in the world economy, what has the past taught us, and our gaze into the future. We've heard a lot about banking from the governor and how well things seem to be going at the moment in Mauritius. So that gives us something of a positive background. I'd like to start off with Lord King and get you to tell us, please, Mervyn, what similarities, what differences do you see between this crisis, this series of perturbations, and what happened in 2008 to 2009, a wholly different set of antecedents, of course. And do you actually believe that the banking industry, which you've described many times as being intrinsically fragile, do you think the banking industry now is in a better state to handle all the immense task of recovery and rebuilding compared with the state of the banking industry as you saw it 10 or 12 years ago? So please, over to you, Lord King, for a few introductory remarks.
Well, thank you very much, David. And let me say how pleased I am to be able to take part in this first of what I think will be a very important series of sessions between the Bank of Mauritius and the outside community. And I want to thank the governor for his important opening remarks. Let me also apologize for the informal fact that I am not wearing a tie. And the reason is really to do with the theme of this meeting, which is resilience, which is all about unexpected events. What is most unexpected is that today it is even hotter in the county of Kent in England than it is in Mauritius. And that means that I need, without any air conditioning, to try to limit the extent to which the heat is bearing down on me at present. But that key word, resilience, I think is now fundamental to policy, both of banking, but indeed of a wider set of economic policy issues. And the most important thing that we've learned, I think, from the global financial crisis over a decade ago now, is that unexpected events occur. We can imagine that there can be banking crises, there can be even pandemics, as we've seen. But that doesn't mean that we have the ability either to predict when they will occur, or indeed even to calculate a probability that they might occur over any well-defined time period. Before the financial crisis, the financial sector, and in particular the banking sector in the major industrialized countries, was seen as the example of the most effective and successful part of a market economy. Highly profitable, attracting the most talented young people to work in it. Everything seemed to be going well. But what the sector had forgotten was that efficiency and profitability are part of an important way of running the banking sector, but not the only part. Resilience mattered too. And the ability to withstand unexpected events that come along is clearly a crucial part of any successful market private sector enterprise. It's no good being efficient if you disappear when something unexpected comes along and you can't cope with that fact. So resilience, I think, has been brought back into focus with the COVID-19 epidemic, where many governments, particularly in the advanced part of the world, couldn't cope with the pandemic because they hadn't prepared for it properly. They couldn't have been expected to know when a pandemic might occur. No one could have said in the summer of 2019, you know, the probability that there'll be a new pandemic from a virus that we haven't seen coming out of Wuhan in China, you know, I think it's sort of 1 in 4 or whatever the number would be. You couldn't consider making a statement of that kind. But we knew that pandemics were possible, and we knew that banking crises were possible. And obviously a great deal has been done since the financial crisis to make the banking system much more resilient. And in the answer to your second question that you posed, David, the banking system around the world is now much better prepared than it was before the financial crisis that began in 2007. Now, there are exceptions. I think on the continent of Europe, the banking system is less resilient. But in many countries, it's a lot more resilient. And the governor has given the figures that all of you will know, that the banks in Mauritius are much better prepared than many banks were before the financial crisis, because they have higher levels of capital and liquidity. Now, if resilience is important, of course, it's resilience to events that we can't predict. So there's clearly a lot of uncertainty about how to make oneself more resilient. But the great strength of the banking system is that we know that whatever the source of the unexpected shocks that may lead us to require to be resilient, we know what the sources of that resilience are. One is sufficient equity capital that's available to banks to absorb losses that may come from totally unexpected directions. And the second is access to liquidity, whether by owning liquid assets or by having access to a central bank scheme to provide liquidity, is crucial when the sources of funding could suddenly dry up for reasons that are never easy to anticipate. Sometimes a loss of confidence is justified, sometimes it isn't, but it can occur, and banks need to be resilient and prepared for it. So in banking sector has one big advantage over many other industries, which is that we know precisely what are the metrics by which to measure resilience, capital and liquidity. So things seem to be in Mauritius on a good track. But there are some questions that need to be raised, and they're ones which I'm sure all of you, and I know the Bank of Mauritius, is thinking about as we look forward. As the governor said, at some point, the measures to provide support to the economy will need to be withdrawn as we gradually come out of the pandemic. We're going through a difficult period now in which the initial optimism about vaccination, which promised a way out of the COVID-19 problems, has been tempered by a realization that there can be new variants of the virus, that there can still be large numbers of cases, even if well over a majority of the adult population have been vaccinated, and international travel is still being disrupted. And as we speak, in the last 48 hours, we've seen that in the United Kingdom, travelers from the United States have now been advised not to travel to the United Kingdom. Israel has banned travel to the United Kingdom, even though we are, in terms of the major industrialized countries, the most highly vaccinated of all. So there is going to be great uncertainty, I think, about international travel. And that means that, in particular, the tourist industry on which Mauritius depends to a large extent, that the outlook for that is clearly still up in the air. Now, I think the big hope is that by the time we get to the winter in the Northern Hemisphere, that these further outbreaks of COVID will have died down, that we won't have seen any new variants, at which point people will be desperate to have a holiday, and Mauritius will be one of the most attractive locations for a holiday in that winter Northern Hemisphere season. So it's far too early to be pessimistic about the tourist season in Mauritius, but there is a lot of uncertainty, and it's very important that the financial sector is resilient enough to cope with problems that could occur down the road. There is also, of course, the time at which the moratorium on repayment of loans comes to an end. And that will be a point at which many possible losses will be crystallized. And so the banking system will need to be ready and prepared for that. Now, I'm not in a position to judge how much needs to be put aside to be ready for that. And the Bank of Mauritius will be on top of that and watching it very carefully. But clearly, it's far too early to be at a point where one can declare complete success and say we are confident that there won't be any more future losses that are realized as the economy opens up. And this is not a moment, therefore, to engage in excessively optimistic actions like paying out large amounts of dividends, which will reduce the amount of equity capital available to absorb losses. So Mauritius starts in a good position in terms of its banking sector, but it's faced enormous challenges because of the disruption to international travel, which has caused havoc for the tourist industry in Mauritius. There has been a moratorium on loans. Both of these will pose challenges as things open up. But I'm very pleased to be able to work with the Central Bank of Mauritius, with a talented team there who clearly understand and are on top of these questions. And I think it's very important that the banking sector works with them in order to ensure that the resilience of the industry, which is just as important as its profitability, is maintained and carried forward into the future. Let me stop there for the moment, David, and ask you or others to come in and comment or ask questions.
Yes, thank you, Mervyn. And in fact, there is a chat function which those of you in the virtual audience can use to put questions. We'll be having a discussion amongst us, the main panelists, for about another 45 minutes. I will then hand over to Mr. Faisal, who's going to be fielding the last half an hour of Q&A with the audience. So please do start sending in your chat questions as soon as you can. Thank you, Mervyn, for setting the scene. both in terms of what happened last time, the differences compared with the situation in 2008, 2009. The banks now like to say that they were then part of the problem. Now they are part of the solution. That's something which we can examine, I think, as we go through this discussion. Thank you for also putting the emphasis on Mauritius and the tourism industry. I'd like to now go on to Vera Songwe. Thank you for joining us, Vera, the Executive Secretary of the United Nations Economic Commission for Africa in Guinea at the moment, where you've been speaking to the finance minister. Let's put all this into an African context. There's been a run on reserves. There's been a danger of shortages of liquidity in Africa. How serious is that? And also, can you tell us about how we should be mobilizing credit in and for Africa at a time when a lot of banks are being told to try to minimize risks? What is the role of the World Central Banking Authority network in trying to mitigate these problems? Vera, over to you, looking forward to what you have to say. You seem to be on mute for the time being. You may have to just press a button.
Yes.
There we are.
Yeah.
Thank you.
I think if we were contributing $1 for every time somebody had to say you seem to be on mute, we would maybe be fixing the world's problems of financing. Thank you very much for having me participate in this conversation and to join an illustrious panel to discuss these issues of liquidity and resilience and the role of the banking sector in this crisis. Let me, first of all, of course, it's very difficult to follow Mervyn and the very, very fine points that Mervyn made and the rest of the panelists. But talking about resilience maybe and liquidity and where we are today, particularly in an African context, as you said, I think there are 3 things I would just like to highlight. Maybe the first one is exactly how confident we are about our measurements of resilience. And I think this is something that I don't think has gotten enough attention yet, and we may want to come back to it at some point. I think after the 2008 and 2009 financial crisis, there was, of course, the whole conversation around stress tests and too big to fail and the risk associated with it. And I don't know that we've had enough impact analysis or impact evaluation analysis post that to see whether we have the right measurements for resilience of our banking sectors across the board. Particularly that in many of our countries, we have banks, financial institutions of varying sizes and varying types, and that we may be necessarily applying the same set of tests for all of them at the same time. And this kind of homogeneity in the diagnosis may not lead us to the right result on resilience. And so there may be, I think, a conversation around how we really measure the question of resilience, particularly in an African financial sector context where our banks are particularly shallow and the financial sector is not as deep and as resilient automatically as the rest of the world. And many of the banks on the African continent have not yet adopted the Basel III conditions. We are still, I think, on our way to that. We're still around Basel II. So my sense on this is the right time to pose the question, and I'm very glad we're having this discussion. But I think we do need some work, and I know that in Mauritius, the central bank has already done a lot of work, and there is maybe things we can learn from central banks like Mauritius, Kenya, Egypt, to some extent as well, Nigeria, on just how one does and maybe one varies the stress test and the modalities of stress tests, depending on the kinds of financial institutions we're looking at. And so there will be a huge role for the regulatory divisions and departments of our central banks on the continent on how that is done. And I think it will be important for us maybe to come back to this conversation a little bit later, is can we segment our financial institutions, our banks, and do different tests on them in different settings. So that's the first one, is, are we measuring the right kind of resilience? Are the stress tests that we're bringing in from the advanced economies robust enough for us to look at our economies? I think the second one is on the liquidity issue. Of course, the COVID-19 pandemic has crippled the world economy. Government debts in many economies have risen. Mervyn talked about one of the things that we at the Economic Commission for Africa have been stressing is again a little bit aligned to the conversation on resilience and differentiation, is that we have not seen the kind of differentiation of our economies and the response to a differentiated African economy that we would like to see. And what do I mean by that? I mean that a lot of the global world's response to Africa has been to low-income countries, but almost 70% of our economies today are low to middle-income economies. On the continent of Mauritius, of course, is clearly a middle-income economy. We haven't seen the G20 or the G7 respond to this middle-income economies that have been particularly vulnerable and even more affected by the COVID-19 pandemic than have the other more low-income countries. And this kind of, I think, response that has been quite divergent in terms of those who are sort of affected the most by the crisis have been the least helped on the continent may lead us to an additional set of problems that we had not anticipated. And I think it's important. And there we are arguing as the Economic Commission for Africa for more liquidity to this middle income economies. Where would the liquidity come from? Everybody is asking. We did play a very huge role on advocacy for the SDRs, the special drawing rights, $650 billion of special drawing rights have been awarded, as we all know, to the global economy. Special drawing rights, printing money, global printing of money, sounds euphoric. But Africa only got 5% of the special drawing rights, and actually 5 countries in Africa got almost 50% of that 5%. So many of the countries that really need the SDRs to help improve liquidity have not gotten the kind of support that they will need if we really want to come out of this crisis as a global collective. So one of the things we're asking for is on-lending of some of the special drawing rights. The G7 plus China is getting about $328 billion of SDRs. The G7 plus China have already given themselves about $20 trillion in additional liquidity to their economies. And so the question is, do they need an additional $320 billion, or can they give 25% of that to African middle income economies? We believe that we should be in a context where some of that is able to be on lent, particularly for liquidity purposes, to middle income countries, the IMF, and we're talking with many central banks to see whether there is ways of mimicking a poverty reduction and growth trust, but for middle income countries within the IMF, and also better access to markets in that setting. So I think this is one thing that we really hope we can work collectively to do in terms of additional liquidity. In addition to that, a lot of the more vulnerable countries from the COVID crisis, interestingly enough, have been countries that are mostly service economies, tourism economies. And so essentially, one of the problems is that they've been double hit, because we're all going into a third wave, and in some places even a fourth wave. And the minute we talk about going into waves, we talk about closing downs. And at some point, 40 African countries had their borders closed down. Europe is closing down, or thinking of maybe not fully opening up. Economies like Cape Verde, like Seychelles, like Morocco, all the economies that are depending on tourism immediately get into trouble, even if they themselves are not shutting. But Mauritius is still closed. You know, if the UK, France, Spain, and all that close down, it means tourism on the African continent also contracts. And so again, lack of liquidity. So we believe that there is really work that needs to be done in seeing how we can work to ensure that this middle income countries on the continent, particularly the service-driven, tourism-driven economies, as Mervyn was saying, are taken care of in the midst of this crisis. One of the things that we are also seeing is that the access to liquidity, and sometimes you will hear the IMF say this, is countries that had good macroeconomic fundamentals before the crisis have access to markets, and markets are reopened for them. This is all true, but the question is, what is the cost of access to markets for those countries? We've done some work that shows that particularly for African countries, market access still remains quite expensive. There is a liquidity component to access to markets on the continent, which we can solve, because that's just a market distortion. It's not the problem of macroeconomic fundamentals on the continent. So we are working to see whether we can replicate the concept of repo markets, which provides you with secondary markets and way of recycling sort of bond offers from the continent. We believe that if we were able to do that, just like in the United States, the repo market size is about $26 trillion. In Europe, it's about $7.2 trillion. In Asia, it's about $3 trillion. We believe that if we fix this market distortion, we can actually reduce the cost of Africa's paper and increase the demand for it, which will allow for more liquidity on the continent. So I think while we are strengthening our domestic continental banks and eventually can work more in local currency, we believe that fixing some of the more global financial sector distortions in sort of the global environment. We're looking to the G20, we're looking to the G7, we're looking to the BIS, the FSB work, to see whether, you know, Africa is oftentimes forgotten in some of these big discussions. And even sometimes, you know, we see regulation that is done that goes against us. And I think about correspondent banking regulation in 2008, 2009, where Africa suffered because we were trying to fix, yes, the right problem in the advanced economies, but what happened was that trade credits on our continent contracted. In this case, it's the reverse. We have repo markets in the advanced economies that is helping to provide and inject a lot more liquidity into those markets, but the non-existence of such markets on the continent, or even in most frontier market economies, including Latin America, and that is making the cost of resources when we need them the most quite expensive. I call this dynamic divergence. In some sense, Germany is going to the market at negative interest rates, and is going to be able to go out. Germany has access to the ECB, so they have a lot of resources. Mauritius needs more resources, doesn't have access to the ECB or a strong foreign currency, and the cost of its resources are quite expensive, and it needs them even more than Germany. So that kind of divergence, if it continues for too long, I believe that it will be very difficult for the global world to come out of this crisis in a collective and harmonious way. What we may end up having is that, you know, there will be an even bigger gap between the wealthy economies and the emerging market economies. We already see that in our exports, export numbers. The exports of Africa haven't been able to pick up as fast as exports from the other advanced economies of the world, and we need to close that gap. So I think working to create some of these systemic missing market infrastructure policies on the continent is going to be important for us. Is creating a repo market to ensure liquidity. The second thing is making sure that we can unlend the SDRs, and particularly to middle income countries that need them the most. And then the first one, in conclusion, of course, is where I started, around resilience, how we measure resilience, what kinds of stress tests we do, and how we differentiate our banking systems and our banking sectors within the continent and even within countries in terms of what markets they serve and how we measure resilience in those contexts. Thank you very much.
Well, thank you, Vera, for making those points with such great eloquence. And we could have a session just, I think, on the international monetary aspects of the crisis. And you very rightly highlighted the SDR issue. Just before I go over to Robert Wardrop, who's going to be talking about the future of banking, I just want to bring you in briefly, Mervyn, if I may, on this issue of the SDRs. In your book, The Alchemy of Finance, you did also speak about a much greater role for the IMF, also a whole series of swap lines that you advocated. I believe somewhere in the book you used the phrase also, let us use the audacity of pessimism. And one has to be fairly pessimistic, I think, about this dynamic divergence that Vera is talking about. So what would you do on the SDRs in order to make sure that the SDRs do end up in the right place and not with the rich countries that don't really need them? Just a very quick answer, if I may, please, Mervyn, and then we'll go over to Robert.
Well, two brief points. Vera made two very important points. One on the SDRs. I think the G7 and the wider industrialized world should just transfer some of their SDRs to low-income countries. That seems to me a very natural and sensible way in which they can help the world recover from this very difficult situation in which we find ourselves. So I think that was it's a very important point, and I would encourage Vera to proceed with trying to get this transfer of SDRs made. The second very important point that Vera made was how we measure resilience. Now, I said that banks have the advantage that capital and liquidity are the two basic metrics, and I think that's true. But we shouldn't rely on the international Basel numbers as correctly measuring resilience in all cases. So the important point about stress tests is that there shouldn't be, and I think many countries in the advanced world have misused them. They've tended to say, this is the stress that we're going to test against this year. I don't think that's sensible. I think you need to have a number of scenarios against which you conduct a stress test, and then you try to find out whether a particular bank is vulnerable to one scenario, but not really the others, or whether a bank actually can cope just about with many scenarios. That's really what resilience is. It's coping with a series of unexpected events. But I think Vera was quite right to stress the importance of recognizing the heterogeneity of different financial institutions. When it comes to assessing resilience, you need to look at the individual institution. But we know that ultimately in a bank, it's capital and liquidity that matters.
Thank you. I'm now going to bring in Robert Wardrop, who, as you know, is the co-founder in Cambridge of the Centre for Alternative Finance. We've been speaking a lot about the present crisis, Robert. There's clearly a lot of opportunities that stem from this, from technological innovation, digitalization, places where we know there's been great strides in mobile phone technology, for example, in using that for the banking system in Africa over the past 10 or 15 years. What is the outlook for Africa in terms of those relatively positive opportunities? And also, could you just look into the crystal ball, look into the year 2030, and just tell us about the changes that you think both beneficial and potentially disadvantageous that could be taking place for the banking industry, with a particular emphasis on Mauritius and Africa? Thank you, Robert.
Thank you, David. We did some research last year trying to understand the impact of COVID in conjunction with the World Bank, and really trying to understand what the adoption of what we referenced as fintech service, digital financial services as a result of COVID. And what we observed was countries that had more stringent measures with respect to pandemic lockdown, actually the adoption rates were higher. So, this is perhaps makes sense intuitively, but really driving and accelerating the adoption of financial services has a number of positive knock-on outcomes and also some challenges. So clearly, the adoption of digital payments accelerated during the period. And again, we saw that higher adoption level, higher transaction levels versus, say, a year ago and baseline, where those stringency measures were particularly high. Now, this has a very positive, this introduces an opportunity clearly, because as we see in markets like Kenya, many markets in East Africa, once you have the payments flowing, you then, of course, can then begin to layer on other financial services. I think, Kenya is a good example of moving to savings, then moving to lending as you begin to capture data. And of course, the outcome is a significant increase in financial inclusion, which is a key objective of many regulatory organizations in the region. With respect to kind of resiliency, I think I would characterize for banks what is an extraordinarily uncertain operating environment that is not just specific to pandemic effects. I think we're in an interesting period where regulatory uncertainty is significantly increasing. And that is being driven by technology change. Regulatory perimeters are blurring. If we think about different activities that give rise to risks in the area of cyber, in the area of crypto assets, data protection, areas that were really not the focus of any regulation 10 years ago, and actually are not specific in many ways, certainly in the case of, say, cyber, to what you would consider to traditionally be regulated industries. So these are very cross-cutting. You have new players coming in, a shift away from, of course, entity-based regulation, taking a risk-based approach to activity-based regulation, but then hybrids in between. So the operating environment for firms is very challenging as regulatory uncertainty is increasing. I mean, and particularly climate-related disclosure, ESG, which is a shift in political economy sentiment, I would argue. That's not so much technology change. So I think the challenge for firms as we move towards 2030 is that while this digitization introduces a number of different opportunities, positive social outcomes, enables more agility in terms of firms, it introduces significant challenges in terms of compliance and reporting. Banks today, I think, are struggling, frankly, to understand that and maintain that alignment between activities regulatory obligations, risk ratings, and then the controls that go into place to manage those risks. And even the most largest sophisticated banks in the world with respect to internal processes are struggling with this. I think if we take a look at, the settlement between the Fed and Citigroup last year is indicative of this misalignment. And so what this suggests in terms of a resilience context in the coming days is the importance of focusing on introducing technology to increase the automation and managing compliance and reporting with more precision, accurate, and at lower cost. And of course, the mirror to that on the side of supervisors is using and deploying technology in supervision. And I think that this, as a result, is a real call for more collaboration between industry and regulators in evolving standards, particularly data standards, to enable the interoperability needed to have these processes and applications that can actually manage this risk, manage these obligations in the period of this increasing uncertainty is very, very important. So if the banking industry in 2030 is going to be faced with a great deal of competition from big techs. We did some research last year with the BIS that showed the growing market share of big techs, particularly in payments and lending, decentralized market infrastructure, increase of digital assets. This operating uncertainty migrating to platform business models, again, I think is going to be very difficult to execute in a way that is well managed from a risk perspective without increasing the automation of regulatory compliance and reporting functions within firms. So I'll stop there.
Well, thank you, Robert. Again, as with Vera, one could fill a whole session really just talking about technology and the way it's going to affect the regulatory side as well as the actual banking operations. And the pieces of research you did, maybe through the Governor's Office, you'd be able to circulate the research that you did to those listening on the call, because I think it would be really important to know about the research that you've done in the background. We're hoping that Natasha Valla will join us, and it will be particularly apposite because she has written a book which has just come out in French and I believe is on the way out in English as well, on the future of money. And so she has a lot to say about the digitalization area and banking in general. Hopefully she'll be joining us before the end. I'm going to ask Daniel Esso now to say a few words. Daniel, you are the CEO of the Mauritius Bankers Association. In a sense, you've got the most difficult task here because you're speaking under the watchful eyes of many of your peers from the banking industry. Perhaps you'd like to follow on what Robert said about the challenges for the sector looking towards 2030, the problems of actually financing the technology for groups that may be part of much larger groups, but still Mauritius may not be the most important part of their operations. But also just do give us a photograph of the present situation. Lord King, in what he said right at the very beginning, did drop some words, I think, hinting that because the full effect of the lifting of the moratorium and so on clearly has not yet been felt, that there may be some surprises still to come in terms of the real state of resilience of the banking industry in Mauritius. We've heard about from the governor about the NPLs appearing to be quite healthy at the moment. How much of that is real? How much is that the effect of the crisis measures? So perhaps you could give us a snapshot of what's going on at the moment, but also a look into the future. Over to you, Daniel.
Thank you. Thank you very much, David. I hope you can all hear me and the connection is stable.
We can indeed. And please do remember to send in your questions while Daniel is speaking, please, those of you in the audience. Thank you.
Thank you very much. Quite a lot to unpack in your question. I think I'll take away two main strands of that. One is a general commentary on resilience from a Mauritian perspective. Of course, we're not the central bank, we're the commercial bank's perspective. That's one thing. And secondly, really talking a bit more about digitalization and the future, if I may. So perhaps I might take the first point first on resilience. Indeed, looking at the indicators, the Mauritian sector is proving resilient, and that is good for all of us so far. I think I would repeat the statistics that the governor of the central bank has given earlier on adequacy ratios and asset quality. But I think there's a few reasons to that, and a few, of course, questions arising from all of this. I think some of the reasons why we have been relatively shielded so far are firstly that Mauritius was an early adopter of the Basel frameworks and has embedded that fairly early on. So banks were prepared in terms of their risk management tools and in terms of their adequacy. Another reason is that banks have been fairly prudent in Mauritius. I mean, the loan to deposit ratio is fairly conservative. That's not a great thing when there's a gold rush, but in times like these, actually, that relative prudence is very, very welcome. The third point relates to really commercial strategies and the fact that while we have a diversified economy in Mauritius, banks have really gone beyond the shores of Mauritius and actually lending regionally, which means that there are greater avenues for balancing books and diversifying portfolios. And nowadays, whether it's in terms of deposits or in terms of assets, banks are really sort of bigger than Mauritius in many ways. A few things have helped us along. Deposits are up and stable. You know, one of the things that might have been a risk in such times would have been some sort of deposit loss, and that has not happened. In fact, it's gone up. We have been helped quite a lot by the central bank in terms of the FX markets, and I know that there have been regular interventions that have actually helped operators tick along and continue their activities, and that has in turn helped the banks. Banks, of course, have also helped by managing their treasuries fairly tightly, and that's been a good area. So we've talked about deposits, we've talked about the FX market. And we now move on to assets. So I talked about diversification earlier on, but of course we've benefited from a number of support measures from government and from the central bank. We've been discussing this package of measures over several months, and that the result of that has been a relative shielding from the most adverse effects of an otherwise unsupported situation. And I think it is absolutely correct. We're now really starting to discuss how to wean ourselves off those measures. I think the signs of recovery are there. And none of it must be too brutal. I mean, there's nothing worse than actually sort of taking off the stabilizers and falling off straight away. I think it's really a question of doing it gradually in order to not give the perception that there's a sudden spike in NPLs. And we're doing quite a few things around that. I think banks have started to look at their collateral, have started really talking closely to their customers and their clients to really make sure that they have a good grip on the client's liabilities, on collateral cover. The last thing that I think I might comment on when it comes to resilience is liquidity. Again, it's quite a lot of it floating around at the moment. That is normally not such a great thing, but as Lord King was saying earlier on, actually, equity capital and liquidity are two things that protect banks, and there has been liquidity in the system. And that has been, I guess, a blessing in quite a lot of disguise. So I hope those 4 points maybe just paint a broad picture from an operator's perspective on resilience. And I don't know if you wanted to stop there and talk a bit about that before moving on to Bob's points.
Yes, thank you, Daniel. We do have Natasha Valle who's joined us now, so I'll leave her to get herself warmed up, so to speak. But just before we do that, Daniel, could you just tell me, has there been one thing that you've learnt as the president, as the CEO of the Bankers Association during the pandemic that you wish you had known earlier? Is there one thing you'd like to tell us, one key principle learning over the last 18 months?
And I've taken a very good week off in early March 2020.
That would have been the one key thing. Natasha, I have introduced you already as the author of a very famous book, or the co-author of a book which has come out now in France called L'Avenir de la Monnaie, which I believe is now out in English as well, from a multilingual country like Mauritius. That should be a bestseller, I would hope. Could you tell us about how you think the European banking industry has coped with the crisis so far? Also, we've been speaking a lot about the need for investment in technology. How are the Europeans going to cope with all that when there's these huge challenges from the European downturn, plus the challenge of really getting ready for a digitalized world? Perhaps you could say a few words about that. Thank you for joining us, which I know has been technically a bit difficult today.
Thank you very much, David. And indeed, I want to apologize because I've had very trivial technical limitations here. I only have a room for 1 hour, and it was a bit difficult to organize it. As you can see, I'm not in my office in my usual location, so I have to apologize for that. But yes, on the state of the European banking system, I think it's a very telling example of how a system has been hit by the crisis, but has been hit by the crisis in an environment where they were, the banks, European banks, structurally in a challenging shape already before all this happened. I don't know how much time I have, David, for this, but I have 3-4 points that I would like to make.
Yes, if you could make them in about 7 minutes, I'd be very pleased.
Right.
Thank you.
Right. Yeah, sure. So to summarize my points, and then I will dig more with some more data and substance. But the first thing we can say about the European banking system is that it's more solid than before, in the sense that it has been, facing increased regulation in terms of capital requirements and also liquidity requirements. So this solidity is a key fact. But at the same time, and that's a second key fact that is differentiating European banks from their, for example, US peers, is that they're not worth anymore their equity value. So the price to book ratio is very, very low in comparison to other segments of the banking sector worldwide. So we can go through the main reasons behind this underperformance of the European banking system, and then I go through some of the ideas we may have to improve the competitiveness of banks, and I'll go through some aspects of digitalization. That's only one part of it. So when you look at how banks have evolved over time since the first crisis in 2008, owned funds of the banking system in Europe has gone up by 60%. The ratio of coverage of their liquidity needs has been above 100% since 2011, and it's now, it's peaked in 18-19 at 160%, gone down a little bit. But they've shown that they were in a position to face a large economic shock. So that's the fact. But again, as I was saying, if you look at the evolution of the price to book ratios, but also fundamentally behind this, the evolution of the cost of capital of European banks, it's a lot less favorable than other, when I say European banks, I say EU banks. It's a lot less favorable than in other areas. And in fact, the cost of equity has been systematically above the return on equity ever since the 2008 crisis broke out. The difference improved a little bit in the years 2016, 2017, but the gap is widening again since then. So European banks are destroying value at the moment, and it makes them a lot less attractive for investors, and it limits their ability to invest in the key sectors that the financial industry has to invest right now. Over the past 20 years, the market cap of the European banking sector has gone down 20%. So I'm giving you the orders of magnitude of what has happened to the sector over the past 2 decades. So in a sense, the shock of the pandemic came on top of structural weaknesses that, in a sense, were visible beforehand. One key dimension to take into account in Europe, in particular when we compare the US banking system to the European banking system, is that scale effects are not achievable to European banks because, you know, as much as we have made a lot of progress on banking union, it is still very difficult for European banks to spread activities across borders for you know, legal reasons, for cultural reasons, and for regulatory reasons as well. I don't want to dig too much into that, but that's something really key. When we look, a second element that I would like to highlight in terms of the placing the European banking system in the whole ecosystem of financial intermediaries is that many of their activities has become contested by new players. If you look at the four main activities of the banking system, being distribution of loans, maturity transformation and risk transformation, risk allocation, and transactions/payments. Before, the only contesting actors were credit card companies. Really, you had banks, credit card companies on the banking on the payment side, and they were on their own to finance the European economy. There was not so much needs. I mean, European firms, non-financial corporations didn't have so much of an appetite for other forms of financing because the banking system was able to form the basis of the savings allocation. I'm simplifying a little bit, of course, because other large institutions were also back then important for the channeling of the savings into the productive sector. But now, when you look at those four segments of banking activities, there are lots of actors. You have the neobanks being very active in the distribution function of the banks. You have fintechs being active for the payment system, the payment function, so to say. Also specialized players, big techs, of course, are there. Shadow banking for risk allocation is also gaining pace with different intensities across European countries, but still this is a generalization of the pattern. And then for transformation, you also have fintechs, neobanks, and the shadow banking. So the ecosystem is really changing. And I think here I come to the solution. I know I have only two minutes left, but I'm not sure that so far in Europe, the banking system has been seen as a strategic stake for which policies should be formulated, or at least political thinking should be sort of devoted. There's one dimension, and I'm saying this because a lot of things are being discussed in Brussels at the moment. We'll discuss other dimensions later, but right now, for example, the stability of the banking system is key for financial stability in Europe, if only because banks are still the main financier of real economic activity in Europe. So the longer we stay with a banking system which is undervalued or not able to create value, this will be a threat for financial stability. So there's a sort of need. I mean, it's more than a need, but it should be a focus for policymakers to make sure that this situation doesn't continue. A second element is that there's a sovereignty dimension to it. Through the crisis that we've seen, 2008, the pandemics, but also in between the sovereign crisis in Europe, we've seen that the banking system has been useful. I mean, in 2020, if banks had stopped providing credit to the economy, that would have made the job of fiscal policy a lot more difficult. And fiscal policy has had to intervene in any case to support lending with different schemes across countries, but the idea of having, a guarantee behind lending was a well-spread policy reaction. But again, without a resilient banking system and a long-standing banking system, as things are right now, there's a sovereignty issue for Europe. And then, very specific to Europe as well, maybe less relevant for Mauritius, but because European countries have such different positions in terms of ability to save and allocation of international investments, that you need players to be able to allocate savings from, countries in excess of savings to countries in need of savings. And we have those disequilibria within the European Union and the euro area. So those are reasons why that there would be a case to look at why the banking system is in such a shape, maybe look again at the regulatory conditions that have to be met right now and the way in which they can be adapted, and look maybe also at the way the financial ecosystem will converge to which model the financial ecosystem will converge to, namely what percentage of bank intermediated funding, what percentage coming from alternative players, and have a strategy towards that, instead of letting things, sort of slide in a situation which we know in the long term is not going to be sustainable. So I hope I was concise enough, David.
Thank you, Natasha. Yes, you've made a remarkable contribution there, and I'm going to just throw in a very quick question to Mervyn in a moment, because you uttered that word sovereignty, which I think is a really key word, and one for Mervyn that I know he pricks his ears up on that. I would like them to then go to Vera and get into this question about the sustainable banking models, which I think everybody has to be interested in Mauritius. But just before that, Natasha, again, another one or two word answer. If you're looking for cross-border banking, isn't it about time that a French bank took over a German bank?
You didn't say an Italian bank, because you're nice. That could also be an alternative. This is something, this is a topic which I've always found difficult. The arguments are there. The arguments are definitely there. The difficulties, the objective difficulties for this to happen and to make it operationally beneficial are there. But each time this was discussed in terms that were becoming concrete, there was always, and maybe Mervyn has a better knowledge of that because he was also at the core of the discussions, but there was always a reflex from national authorities to prevent what was perceived to be, a sort of takeover of a domestic jewel, or of something that has had a symbolic dimension for one of the European countries. So the thinking, the national thinking, notwithstanding the difficulties, the national thinking was there to prevent some possible improvement.
It just shows what a complicated place Europe is. Just before Vera and sustainability, Mervyn, are you also worried about the fact that the European banks are just too weak at the moment, and therefore will not be able to live up to all the expectations that are heaped on them?
Well, I think Natasha argued very clearly that at present some of the banks are indeed weak, and there will undoubtedly, I think, over the next few years be a question of how it's going to be possible to absorb some of the weaker brethren in this family, amongst others. You asked, Natasha, isn't it about time that a French bank took over a German or even an Italian bank? But as Natasha knows very well, there are a number of German and Italian banks that she would not want a French bank to take over. And therefore, I think that you've got to deal with the weak banks on their own merits, not simply ask someone else to take them over.
Yeah, thank you. I'd be very interested in what you have to say about digitalization in a moment, including the CBDCs. That's really a huge issue. We've only got half an hour left. Vera, could you tell us a bit about what your models would be and how you would go about introducing what you might call sustainable business models into both Mauritius and Africa more generally? And then let's have Daniel and Robert on that as well, which I think is absolutely vital for the Mauritius banking industry. And while that's going on, I'm going to beat a retreat because I've got to take part in another call in about 3 minutes, and I will there before handing over to Mr. Faisal, our excellent MC, while you're answering those very difficult questions. Vera, over to you. Again, please, the mute button is on for some reason. If you could just adjust your button.
Sorry, yes, please. No, we were having a connectivity problem, but it's fixed. Thank you. No, I think on the question of sustainability and how one brings sustainability into this conversation, three things. The first is really how do we measure, and it goes back a little bit to this question of resilience, right? We've seen what a health crisis has done to our financial systems, and here we are talking about sustainability on the continent. The whole question around climate change normally accounts now for just the response to climate change related events is 5 to 11% of Africa's GDP. In some countries like Mozambique, even more. And in Mauritius, we've just seen the cost of the oil spills and what that costs for the economy. So I think there is, again, this differentiation of sort of stress test. And maybe then, and the part of my previous answer is working with the banking system, but also the insurance and regulatory systems. And we're learning a number of things, for example, from the United States and California, where we see the sort of fire insurance and the banks that are more exposed to insurance companies and fire-related insurance having a very different trajectory in terms of their resilience capacities vis-a-vis others. I think one needs to look at what new dimensions of resilience and sustainability we need to put into some of our stress tests as we think about climate change, which is not going to be temporary, as is, we hope, the COVID-19 crisis. Climate change is here with us to stay. So again, a different set of indicators, a different set of measurement points that we will have to follow. What we are doing on the continent is we're doing two things. We're saying, first of all, that we believe that designing or redesigning, resetting our economies to sort of rely more on a recovery and new growth coming from sort of climate sustainable type investments and sectors is going to be particularly important. For Mauritius, this is important because Mauritius has already been a tourism economy anchored around sustainability. How can we do more of that? How can we do it better, but ensure that we now design it in a way that it actually, the banking system reflects that part of it, not just on climate. And I think what COVID has done to us, it has shown us what, you know, a climate event and how a climate event can stress the financial system and how a health event can stress the financial system. We can use that now as a sort of mock test for sort of measuring how a climate event of a similar magnitude can stress the financial system and what kinds of responses we will have to that. I think the G7 and the G20 already have a standardized set of climate-related reporting. It hasn't been fully adopted, and we do need to work on it a lot more, not just for Mauritius, but also for a lot of the small island development states, and I'm thinking of Barbados and the rest, that both are middle-income countries, depend on tourism, and depend on climate sustainable tourism for their growth. What kinds of systems and structures in the financial system should we be looking at to work with them? And again, that collaboration between the insurance sector and the banking industry becomes even more important for measurement in that. I'll stop there. We could talk again. And this, I think my final point is the importance of the regulatory systems taking into account this climate change and resilience component as they work to redesigning what resilience means in the financial sectors. Thank you.
Well, thank you, Dr. Songwei. We now will be moving to the questions and answers sessions. And please bear with me, it's very difficult to fill the shoes of such a great moderator like David Marsh. So I'll try my very best to stand up to the challenge. We can take questions from the floor, please. Ladies and gentlemen, if you have any question, please feel free to ask them right now. I think that we will be having just 10 minutes maximum. So very concise questions and the answers will be adequately short. Please.
Yes, please.
Yes, Mr. Manley.
Actually, I have a lot of questions, but in terms of time, I will probably narrow it down to just one. I'm Matthew Mandeng, the Chief Executive Officer of Standard Chartered Bank, Mauritius. Thank you very much for your insight to all the panelists. My question goes to Vera. Actually, you talked about the availability of liquidity and cost of liquidity in Africa. One driver of liquidity on the continent was the presence of global or international banks providing liquidities either for corporate or to other bank to correspondent banking arrangements. But one movement that was visible even before COVID-19 pandemic was global bank de-risking the continent from the financial crime risk perspective. Some exiting, some other reducing their presence on the continent. In fact, Standard Chartered is one of the rare global banks that decided to de-risk by raising awareness, educating, to the extent where we actually created the correspondent banking academy, but also strengthening the risk management and the controls. So my question to you, Vera, is I know you do already a lot on the continent, but what more can you do to sort of help reduce the cost of financial crime compliance, dealing with issues around AML, CFT, anti-bribery and corruption and sanctions, in the context where July 11 was the Africa Day for ABC, for anti-bribery and corruption. So that's my question to you, Vera.
Should I just come in?
Sure, please.
And then I'll be short. No, I think that's a very good question, and I guess I looked for it. Of course, we saw in 2008, 2009, as I said, when new rules were put in place and more stricter clarity at the time. Vala, the sort of French, the French president at the time was going after illicit financial flows in Europe. The biggest painful, I think, people who paid for that was Africa and the correspondent banking system. The first thing that I have been arguing about is that we need African presence in those global regulatory bodies. Because I remember talking to Christine Lagarde a year later and saying, did you see the impact of we Africans have been talking about illicit financial flows for a very long time. We have a different process by which we want to go through that. One of them is just mutual legal exchange and information and sort of banking regulation and all. We don't get that. But one morning, a policy response from the G7 and the FSB leads to this sort of flight of capital from the continent because nobody can show KYC on our continent. And so I think the responses to that really is, the first one is really that this regulatory base must have sufficient African representation. And as one talks about changing the global financial architecture, this for me is critical. If you don't have, frontier economy countries, and the G20 is not enough. If you don't have more of these economies around those tables, we will continue to have that regulation. Now on the KYC side, I think actually some of the good stuff that's coming out, and we're learning, and I'll call a country and you'll all be surprised. We're learning from countries like Somalia that are almost all digitized, that it's so much easier sometimes to get information. So I think the whole fintech space will allow us maybe to be able as a continent to respond even much faster to some of these issues around KYC, know your client, and the compliance issues that we are facing on the continent. Thank you. I could go on, but this is, I think, 2 steps: representation on global spaces, and the fact that Africa is leading on fintech and financialization could also be a way of responding to that.
Well, thank you, Dr. Songwe. Please, if anyone has any questions. Yes, sir.
If I may, good afternoon, Mark Watkinson, Bank One. A question for Lord King. Just in relation to what's going on with the sort of ECB and the Fed, there is quite significant continued loosening as far as monetary policy, continued bond buying, which potentially will lead to significant inflation risk. Are we storing up problems for ourselves, or is this a short-term blip?
So this is a question primarily, I think, about the United States. It can apply to other countries. We've seen the inflation rate in the United States jump up to 5.4% from below target levels, but well below 2%. This has clearly taken the Federal Reserve by surprise. I think the concerns that we should have are not about the immediate inflation numbers, which I suspect do contain a significant transitory component. We've already seen some of the concerns diminish. Lumber prices have fallen back very sharply. The growth rate of broad money, the monetary aggregates, has also started to decline. So I think central banks are right when they say that part, at least, of the rise in inflation will prove transitory. But I think the bigger concern, and the one that it's very hard to evaluate at present, is whether the apparent complacency of central banks in the last year or two means that they will not be prompt in taking action to head off what could be, but we don't know yet, but could be a rise in inflation to above target levels. And I think the way in which central banks in the advanced economies have been prepared to give what they call forward guidance, that is to effectively say, well, our belief is that we won't raise interest rates for another 3 years. That is a very peculiar thing to do. I don't believe the Federal Reserve can possibly know what interest rate they want to set 6 months from now, let alone 3 years from now. And I think the explanations that have been given for the magnitude of quantitative easing have also become more blurred and less specific to the circumstances of the shocks to which economies have been subject. And I think the political pressures on central banks are growing. So whereas in the 1990s, when central banks became more independent around the world, adopted inflation targeting, the political pressures were behind what the central banks were trying to do, because people remembered the high inflation of the 1970s. Not that many people today can remember the inflation rate of the 1970s. And so I think you will find that the political pressures on central banks to help governments finance their budget deficits, which are not going to disappear quickly, the involvement of central banks in wider political questions like climate change, I think these things will make it more difficult for central banks to act quickly and promptly to deal with inflation risks. So I'm not so much concerned about the immediate numbers, but I am concerned that central banks do not seem quite as concerned about inflation as they used to be. And the pressures on them will be to make life more difficult for central banks to combat inflation than it was when they successfully did that in the 1990s and early 2000s.
Please.
Hello, it's Grant Parsons from Investec Bank. A question for Natasha or possibly Robert. When we talk about bank resilience, we talk about the concept of excess capital and excess liquidity and creating buffers. How do we reconcile that concept around bank resilience with the bank valuations and shareholder requirements of return on capital and the issues I think that you're seeing at Europe at the moment?
That's a very sensible question indeed. I mean, when you look at the cost of capital, return on capital, and the extent of the buffers, different measures, one very quick, fix would be to change the burden, to mechanically adjust, so to say, the value, to speak very quickly. It's a bit of a double-edged thing, though, because in what I've said, there's one positive thing that I said, which was to say the banking sector was resilient enough to withstand the shocks that have occurred. And this strength, which is also probably the root of their weakness right now, as I would agree with you on that, came from the fact that they are overcapitalized. So there's a bit of a feedback loop between the two, and the balance to be found in where to put the limit, where to draw the line. My approach would be perhaps to have conditional on having a really strategic plan for the banking system, not only by public authorities, but by the banks themselves, on their future model, their future operational ratios, on the future nature of activities that they want to cover, conditional on that, having a bit of giving them a bit of leeway to adjust to those to this, transition to the new business model, so to say. But by lifting capital constraints, you will not be able, or I don't think that would be sufficient to induce banks to work on what they can influence themselves. And here you have a number of levels that you can then work backwards to find the right KPIs for them, either regulatory or not, but what kind of specialization do they need to have? What kind of leverage is sensitive for them to have? How should they price risk? What is the level of operational excellency that they should aim at, so that their structural ratios make them, a sustainable business? So it's I know I'm not answering your question because it's a very difficult one. I would be in favor of giving them some leeway, but it's a bit like the conditionality principle that you apply to programs, the public sector, conditional on them having some reasonable plan for the reform of their business model and the operational ratios.
All right. Is there any additional question from the floor? If there's none, then Governor, you would allow me to ask one question on behalf of the banking supervision team. And the question is addressed to Lord King. So I'll read the question. So it's very true that European banks are more resilient than they were in 2008. Nonetheless, the market has been pushing for a wave of consolidation in the European banking markets, be it in Italy, Spain, or Germany. And they are even asking to create a Pan-African European bank, a Pan-European bank, sorry. This case is particularly interesting for Mauritius, where we have 18 to 19 banks. And as Lord King says, the impact of the crisis is quite likely to last. So therefore, would it be avant-gardist for banking shareholders to consider consolidation to preserve the value in the banking industry?
So can you repeat the last part of the question again? I got the bit about the European banking system. It was the part about the Mauritius banking system.
Yes. So would it be proper then for banking shareholders to consider consolidation to preserve value in the banking industry in the current context?
So I think I don't know what the right answer is in Mauritius, and I'm not qualified to answer that. But in terms of the European banking sector, I think there are two reasons for thinking about the need for consolidation. One is the one that Natasha referred to earlier. It's clear that the price to book ratio of many European banks is so far below 1 that the market really doesn't believe in the value of the franchise of a number of banks in the European euro area. And the right way to deal with that is to have some degree of banking consolidation. Now, that may mean taking capacity out of the system. And that's always the thing that raises difficulties when dealing with the political boundaries between member countries of a common currency area. That is unique, I think, to the euro area challenge. It will be a challenge anywhere, but it particularly matters when taking out capacity from the system is going to fall on one particular geographical and political area. But there is no doubt that in the euro area, there is excess banking capacity. The market valuations reflect that. The European Central Bank is basically keeping a number of these institutions on life support, and some measures will need to be taken. it would be, I think, a big boost to the euro area to have a pan-European bank. Now, of course, in some ways, there are already pan-European banks. There are banks which may be headquartered in one country and have a national label, but operate across Europe. One of the experiences which anyone involved in banking in the last 50 years must always remember and never forget is that the experience of trying to engage in retail banking in other countries has often turned out to be a disaster. So, for example, every attempt by a British bank to acquire an American bank and operate in the United States with retail customers has led to failure. So there is something about retail banking that is difficult to carry across borders. That's not true of many of the wholesale activities, but it is true of retail operations. But the euro area would benefit by having a bank that was seen as a euro area bank and not attached to any one nationality. But I think the question of excess capacity handling these issues is very much tied up with the health of the economy itself. And it's quite possible that if you end up with an economy that's really struggling, that you discover that your banks are going to find themselves in difficulties. Most losses of banks tend to originate with erratic and volatile macroeconomic policy rather than bad decisions taken by banks themselves. There are, when you get real deep recessions in an economy, that's when you get very substantial losses. It's not easy to anticipate when and how that will occur. So I think the issue of banking consolidation is a particular issue for the euro area in Europe. I don't think it's a major issue that holds elsewhere, perhaps in China, but much less so in most other countries.
Well, thank you, Your Lordship. Well, ladies and gentlemen, the questions and answers session being over, we shall, unfortunately, I would say, need to close this session. But I would like to bring to your attention that any question that you may have or that you viewers may have can be sent to the Bank of Mauritius on communications@bom.mu, and we will make it a must to answer those questions within the shortest possible delay. But before that, ladies and gentlemen, please join me in thanking our eminent panelists for having enlightened us with their precious views and insights, and this in spite of their busy schedule. So, Your Lordship, Professor King, Dr. Songwei, Dr. Vella, Dr. Wardrop, and Mr. Esu, thank you once again. And our appreciation also goes to the CEOs of banks. And we would not be able to forget Mr. David Marsh, the moderator, for his brilliant achievement in leading this panel discussion. Well, I'm certain that you all look forward to the next editions of the Bank of Mauritius Thought Leadership Series, the dates of which will be communicated in due course. And to our viewers, thank you for having joined us in Mauritius and overseas, and we look forward to meeting you another time. Thank you.
Thank you.
Thank you.
Thank you.
Bye, Vera.
Thank you very much, and goodbye. Thank you.
Goodbye all, and apologies for connecting that late, but
Well, Vala,
Goodbye,
you
Natasha.
have the same problem I connected to. Thank you.
Well, ladies and gentlemen,